There are moments in financial history when the public believes nothing is happening, while the people who design the system quietly prepare for a transition that will only become obvious at the very end. And right now, whether most investors recognize it or not, XRP has entered that exact phase, not because of speculation and not because of emotion, but because key structural triggers inside the global liquidity system have already begun. This isn't a prediction. This isn't hype. This is the part of the cycle where the countdown starts long before anyone hears the alarm. Before we break this open, remember, nothing in this video is financial advice. It's for informational and educational purposes only. Always do your own research and consult with a licensed financial professional. And as of this moment, XRP is trading in the low $2 range. Now let's talk about what almost no one notices. Countdowns in global finance never begin with a public announcement. They begin quietly, deep inside the plumbing of the system. They begin when settlement windows shrink, when liquidity flows tighten, when institutions reroute volume into new corridors, and when the old rails show signs of strain that only insiders can see. That's where we are with XRP right now. Across the last several months, a series of subtle but unmistakable indicators have emerged. None of them trend on social media. None of them cause a spike on the chart, and none of them get covered in headlines. But if you understand how the global settlement system actually operates, these signs tell you something very simple. The shift toward real-time value movement is no longer theoretical. It has already started. Let's break down the first trigger: institutional positioning happening off-exchange. Retail investors watch exchanges like they're the entire world. Institutions don't. Institutions accumulate through over-the-counter channels, private liquidity hubs, and contractual access that never touches the open market. This is why the chart looks frozen while the fundamentals keep accelerating. It's also why, when the public finally sees the movement, the transition will appear sudden, even though the groundwork was laid quietly for months. Right now, we're watching OTC pathways tighten. These aren't rumors. These are structural signals. When OTC liquidity begins to thin, it means institutions are preparing for utility phase corridors that require deep, reliable capacity. Institutions don't buy after the chart moves, they buy before. And when OTC supply no longer meets demand, the system has to pull from the open market. That is the countdown. The second trigger is bond market volatility, which has quietly pushed global settlement systems to their limits. When yields swing sharply, institutions have to reposition massive pools of capital in hours, not days. But the traditional rails can't keep up. Delayed settlement becomes risk, clearing windows become exposure. And the more volatility we see, the more pressure builds on banks and custodians to begin testing real-time settlement alternatives, exactly the infrastructure Ripple has already built. These tests don't show up as volume. They show up as integration work, corridor calibration, and liquidity modeling behind the scenes. Again, the kind of activity that starts a countdown long before the public becomes aware. The third trigger is tokenized assets, and this is the one almost every retail investor underestimates. Tokenization doesn't ask for permission. It grows whether the settlement layer is ready or not. And right now, tokenized treasuries, tokenized real estate, and tokenized commodities are expanding faster than the fiat rails that must settle them. A 24-hour digital asset cannot be settled on a rail system that closes early, delays transfers, and batches transactions. That mismatch forces evolution. It forces a bridge asset. It forces the system to adopt real-time settlement mechanisms. And XRP is already positioned inside that architecture. You don't need a headline to tell you a countdown has started. The system itself tells you: gold liquidity tightening, bond yields spiking, tokenization accelerating, OTC channels absorbing silent demand, corridors being integrated quietly, regulators aligning frameworks behind the scenes. None of these are signals later. They are the signals before the signals, and together they mark the beginning of the transition. This is why the chart looks calm, even while everything that supports it is shifting. Retail sees stillness. Institutions see pressure building. Retail thinks nothing is happening. Institutions see a timeline forming. Retail waits for confirmation. Institutions move during silence. The countdown has nothing to do with price action. It has everything to do with liquidity conditions, and those conditions are tightening everywhere. That's why we're having this conversation now. The system is quietly entering the phase where old assumptions break, internal pathways activate, and the need for instant settlement becomes non-negotiable. In the next section, we're going deeper into the exact mechanics that prove the countdown is real: the liquidity curves, the settlement stress points, the macro indicators, and why institutions are preparing now instead of later. To understand why the countdown has quietly begun, you need to understand how liquidity actually works, not the way retail imagines it, but the way institutions measure, track, and respond to it. Because XRP's next phase won't be triggered by emotion or speculation. It will be triggered by liquidity stress, by inefficiencies that become too expensive to tolerate, and by institutions reallocating capital into systems that can handle modern settlement demands. Let's start with the concept almost no one talks about, liquidity compression. This is when multiple asset classes begin converging toward the same problem at the same time. Gold, bonds, equities, tokenized assets, and cross-border settlements all putting pressure on outdated rails. Liquidity compression creates bottlenecks across the financial system, and those bottlenecks force innovation. We're in that environment right now. For example, look at the bond market. Bond volatility doesn't just affect traders, it affects the entire global settlement pipeline. When yields swing sharply in short periods of time, the amount of capital that has to be repositioned is enormous. Pension funds, sovereign wealth funds, insurance companies. These entities cannot wait days for settlement. Every hour of delay is exposure, and every delay increases systemic risk. Now imagine that happening across multiple markets simultaneously. That's liquidity compression. And this is precisely the environment where real-time settlement stops being a technological luxury and becomes a financial necessity. This is the backdrop for why XRP's countdown has started. Not because someone said something, not because of a headline, but because the system's infrastructure is hitting its limits. Here's the second force driving the countdown: OTC absorption versus public liquidity. For years, Ripple has provided large buyers with OTC access, private channels that don't disrupt the open market. This has allowed institutions to build positions quietly without causing massive price displacement. But OTC liquidity is not infinite. It shrinks as demand grows, and once those channels begin tightening, institutions eventually have to source liquidity from the same place retail does. That hasn't fully happened yet, but the tightening has begun. This is a slow, mechanical signal of the countdown phase. When the open market becomes the primary source of liquidity, the chart no longer reflects speculation. It reflects utility pressure. And that brings us to the third force, tokenization. Tokenization is not a future narrative. It's already happening. Tokenized treasuries are exploding. Tokenized funds are being launched by major banks. Real-world asset platforms are scaling faster than traditional settlement rails can support. Most people don't realize what this means. Every tokenized asset must eventually settle across a liquidity bridge that can handle real-time value flow. Traditional rails were built for intraday batching, not continuous settlement. And as tokenized assets expand, the demand for real-time liquidity expands with it. XRP's architecture was not built for hype. It was built for exactly this environment. Now let's talk about the fourth force driving the countdown: global currency fragmentation. Around the world, we're seeing something we haven't seen in decades: major currencies diverging from historical correlations. In normal markets, currencies move in predictable pair structures. But as liquidity stress rises, those relationships weaken. That breakdown creates settlement delays, arbitrage gaps, and inefficiencies in foreign exchange corridors. Institutions cannot operate in that environment forever. They need a neutral settlement asset, something that can bridge fragmented currencies without adding volatility or delay. This is where XRP's design begins to matter at a macro level. When FX fragmentation reaches a certain threshold, the market naturally gravitates toward a unified settlement layer, not through speculation, but through operational necessity. This is the part of the cycle most retail investors never see. They look at the XRP chart and think the market is asleep. Institutions look at the same chart and see preparation. And that brings us to the fifth force: settlement constraints. Every major financial institution works within settlement windows, deadlines for when transfers must be completed. When those windows narrow due to volatility, institutions face massive exposure. If they cannot settle fast enough, they cannot reposition fast enough. When this happens at scale, real-time settlement becomes mandatory, not optional. This is the environment where XRP thrives, because XRP isn't competing with meme coins. It's not competing with hype. It's competing with delay, with inefficiency, with the friction of a system that's outgrown its own plumbing. All of these forces, bond volatility, tokenization, FX fragmentation, settlement deadlines, OTC tightening, are converging. And what that convergence creates is the countdown we're talking about today. It's not loud, it's not dramatic, it's not visible to most of the market. It's quiet, it's structural, it's systemic. This is why the countdown has begun. The demand for a real-time settlement layer is increasing faster than the current system can adapt. In the next section, we're bringing this into focus. How institutions prepare during the quiet phase, how retail misinterprets stillness, and why the next stage of XRP's life cycle depends on liquidity, not speculation. This is the part of the cycle where most people misunderstand what's really happening. They look at a quiet chart and assume nothing is moving. They mistake stillness for weakness. They think lack of volatility means lack of progress. But in global finance, the most important shifts never start with price. They start beneath it. They start in the infrastructure. They start in the corridors. They start in the places only institutions pay attention to. That's where XRP is right now. Because while retail investors debate daily candles, the system is tightening. Settlement windows are shrinking. Liquidity demands are rising. Tokenized assets are scaling faster than old rails can settle. OTC channels, once abundant, are becoming thinner. Volatility in bonds and FX is pressuring banks to adopt tools that can absorb shock instead of amplify it. This is what a countdown looks like in the real world. Not a headline, not a prediction, not a rumor, a structural shift. A shift where the old rails can no longer support the load being placed on them. And the new rails, like XRP, begin absorbing that pressure quietly, methodically, and without fanfare. The moment retail finally sees the move is the moment institutions consider their positioning complete. That's why you're here. That's why you're early. Not because the chart told you something, because the system did. You're paying attention to the signals before they become obvious. And in every major transition, the people who understand the quiet phase are the ones who benefit most when the acceleration phase arrives. So if you're still here, if you understand the deeper mechanics behind this countdown, then do me one favor before you go. Support the research, support the message, and help push this information further out into the world. Tap like, hit subscribe, and drop a comment with the word quiet phase. It tells me you're one of the few who stayed to the end, one of the few watching what's happening behind the scenes, and one of the few who understands what this moment truly represents.